Hi everyone, my name is Rajiv Rebello. I'm the Principal and Chief Actuary of Colva Actuarial Services. We're the math advisors to financial advisors, and really what we do is help financial advisors implement better tax efficient solutions for their clients. So today in this webinar, we're going to be sharing some of the knowledge we work with financial advisors on. The whole purpose is to help you understand, well, what part of financial advising can I do myself, and when does it really get too complicated where I need to get a qualified professional in order to implement those strategies for me. So again, do I need a financial advisor? What parts can I do myself, and what parts should I really look for a financial advisor to implement on my behalf? So regardless of where you are on the spectrum of wanting to do it yourself versus wanting to get a financial advisor to do it for you, you'll be able to learn knowledge about these strategies and take it away and implement it yourself, or basically be better able to have conversation with your financial advisor to discern who's really qualified and, again, who's just a salesman. So again, I really like to start off presentations by starting with the takeaways. What really, at the end of this presentation, should you be able to take away from it, from your knowledge? And the first one is basically, well, what is a general optimal asset allocation for my age and risk profile? And when we talk about asset allocation, we're really talking about, well, what percent of my portfolio should be in bonds and what percent should be in stocks, and how that kind of allocation changes over time. The next thing we'll talk a bit about is, well, how can I keep fees low by doing asset allocation by myself, which is essentially looking at your risk profile and saying, okay, given my age and risk profile, I should be in this percentage of stocks and this percentage of bonds. And you can really keep, fees low by helping to do that yourself. And then we'll talk about later using low-cost index funds. The next takeaway I'd like you guys to walk away from this webinar from is essentially, what type of assets should I be putting in my taxable accounts, hence stocks, versus what types of assets should I be putting in my retirement account? Again, hint, bonds. The next thing is, should I withdraw first from my taxable accounts or my retirement account? So you're in retirement, let's say after you retire, where are you taking the money from? And we'll talk about that in a second. The next thing we'll talk about was, how can I pay a 0% capital gains tax rate in retirement? The next thing we'll be talking about, well, is, am I qualified to be my own investment manager or financial advisor? And the reason why this is an important point to think about and bring up is, people don't realize that over time you're accumulating wealth. So you have $500,000, you have $1 million, you have $2 million. Essentially what you're saying is, if you're not using a qualified financial advisor, the question is, are you really qualified to be your own portfolio manager, your own investment manager? Do you have that expertise? And oftentimes we think we all have this expertise, right? But we a lot of us who have professional degrees, we're doctors, we're engineers, we're lawyers, we think, okay, we're smart people, but just because you're an engineer doesn't mean you can all of a sudden step in and be a doctor or perform surgery, right? So there are complicated elements of financial advising that you really need to have years of experience in and understand how to use these tools, right? Just similar as a surgeon has certain tools and scalpels at their disposal. How do you use these tools to, again, maximize benefit for you in terms of reducing taxes and increasing wealth, right? So that's a key thing I want you to watch this presentation and take away from, is that there is value in financial advising, and just because you've excelled in your current field doesn't necessarily mean you have all the financial advisor expertise, right, that it takes to implement these strategies or even know about them. Again, I'll close this presentation with the pros and cons of financial advising, so you really understand what to look for in a financial advisor to determine if that person is qualified to essentially provide you advice. And if they're doing the investment management side, helping to determine the proper asset allocation for you and do it in a cost-effective way that just doesn't bill up their fees, right? Again, we'll be talking about the importance of comprehensive financial advising, which is not just putting money in stocks and bonds, but it's really looking at strategies and structures like IRAs, Roth conversions, to basically minimize your taxes and increase wealth by using the tax laws to your advantage. So if you're not a tax law expert, again, financial advising can use these structures to minimize taxes, which, again, if you're minimizing taxes, as we'll go on, you're essentially increasing your wealth in after-tax return. Okay, so let's just get into the bulk of the presentation. So how can financial planning help me, right? So it can prevent you from taking too much risk and running out of money in retirement, right? So if you're too aggressive with your portfolio, right, you can absorb losses, especially as you're entering retirement, and you might not have enough to retire. The other is an opportunity cost. It can prevent you from taking too little risk and running out of money. And as we'll talk about, the opportunity cost often gets overlooked, right? Because if too conservative, you might think you're doing the right thing, but your money's not growing at the rate it needs to be, and so you don't have enough money in retirement because it hasn't accumulated. The impact of compound interest hasn't taken effect. The third thing is really focusing on after-tax returns. So when you really just focus on minimizing taxes as opposed to chasing yield, you're essentially making more money without additional risk, right? Again, one of the key takeaways I'd like you to take away is this importance of after-tax returns. Again, in financial advising community, financial planning can help you with that. The other thing is that when you implement specific financial planning strategies, you're working with an extended network of really experienced or ideally experienced people, right? So experienced CFPs, CPAs, tax specialists, estate attorneys, etc. And these people are in this industry, they do it for a living, so they'll have more expertise than someone who's just learning it for the first time, and doesn't have years of experience implementing these strategies. The last thing is on how financial planning can help me is just holistic life planning. Well, what is it you want to get out of your life, and how can money help you get it, right? So the purpose of money is to use it to your advantage, right? Not just accumulate it for no reason. Well, what is that reason? Do you want to start a business? Well, then it's taking steps to make sure your assets are protected and allow you to do that, and ideally in a tax efficient way, right? So again, I think this also gets overlooked is the holistic life planning and what it is you want to get out of your life and how money can help you get there. And the right financial planning can vary depending on your goals. So we'll go over the agenda here. We'll talk about briefly, the key components of a portfolio, basically stocks, bonds, cash, and alternatives. We'll then go into determining asset allocation as you age and how that changes over time, right? At the beginning, you should be taking more risk, and then as you get closer to retirement, you want to take less risk. But this section will focus on understanding risk, the risk return profile, and opportunity costs, as we alluded to a little bit earlier. We'll then talk about doing asset allocation yourself, which is just, using low-cost index funds, determining your risk profile, how much should be in bonds, how much should be in stocks, and doing that kind of asset allocation element yourself. And there are a variety of providers, again, in the industry that allow you to do this. We talked about when is a financial advisor worth it versus doing it yourself. This is the bulk of the value I'd like you to take from this. In order to understand the value of a financial advisor, though, and some people don't give them enough credence when evaluating them, is you really have to understand the importance of tax-efficient investing, right? And that's really what a strong financial plan will help you do, is like we talked about. Maximize your return without taking additional risk, and that's really just minimizing your taxes. We'll then talk about taxable accounts versus retirement accounts, and we talked about, what's better, what should I be contributing to, what should I be withdrawing from when I'm in retirement, and finally concluding with what should I look for in a financial advisor. So let's jump again right to it. I won't spend too much time on talking about myself and my firm, but you can essentially look at us again as a math advisor to financial advisors. We really focus on working with them to implement strategy after tax, after advisory fee strategies for registered investment advisors and family offices. So again, the math guy, the tax efficient strategy guy. So like we talked about, when you do financial advising with the right partner, you're working with a bunch of qualified professionals. So I fit in there on the after-tax side, the solutions we kind of help implement. So let's talk about portfolio composition: stocks, bonds, cash, and alternatives. What are they, and what do I need to know about them? So we'll start with stocks, right? When we talk about stocks, we're essentially talking about owning equity. We own a small part of a larger company. So, what are the benefits of having stocks in a portfolio? So the benefits are, you can get higher returns, right? You can defer the taxes until you sell the stock. So you're not, again, you can accumulate what's called capital appreciation. So let's say you buy Apple today at $1,000, and 20 years from now, it's at $100,000. So you're not paying taxes each year on that. You're only paying taxes, when you sell. Obviously, if there's a dividend, you'll pay a small tax on that. But the capital appreciation rate, you can defer, right? There's lower long-term capital gains tax rate on that. So we talked about that Apple example. Well, if you own Apple, right, it just has capital appreciation. So let's assume there's no dividends. And for 20 years, it accumulates. Now it's worth $100,000. Well, you're paying lower long-term capital gains rate on that appreciation from $1,000 to $100,000 than if it were bonds, and we'll talk about that in a second. The risk can be diversified by buying multiple stocks, right? So we used Apple as our example, but you don't want to just buy just Apple, right? Because what if a tragedy happens to Apple, right? You want to diversify and get a wide array of stocks in your portfolio, and we call that often index funds will invest in a wide array of stocks to diversify your risk, right? So that way, if Apple does bad, doesn't necessarily mean that Staples or Best Buy is going to be bad, right? So this is how you can, stocks in your portfolio can be used. You invest in a wide array of stocks. You can diversify some of the equity risk there. The disadvantages of stocks in a portfolio, and we'll be showing this, is that it's higher risk than bonds, and we'll be showing you that it's more volatile, or otherwise it jumps ups and downs more drastically than bonds, and higher volatility, which is again just the jumping up and down, and we'll see that in a second. So let's just look at how stocks have performed over 11-year period from 2009 to 2019. On the left-hand side is the annual return, right? 2009 did well, right, about 27, 28%. Then 2010 did pretty well as well, about 15%. 2011, okay. Then again, we've had a strong bull run. But what you should be seeing here is a couple things. Obviously, in the past 11 years, it's been mostly positive with a huge bull run. But you should also see how it jumps up and down, right? It went from 28% one year to 4%, then back to over 30%, right? So the point being is that it can be volatile. So over the long run, you're going to do well. So you can see that the mean return has been almost 14.7%, but the standard deviation in terms of how much it jumps up and down is about 12.21%. The point being is that if you're investing in stocks, it really should be a long-term horizon, right? Because you might do bad in any one year, right? It could be a significant loss, but over the long run, you're going to do well. The question is, well, what is your risk profile? Can you afford to wait a long time to accrue wealth, or do you really need short-term results or protection, right? So stocks help you grow over the long term, but can be volatile in the short term. So that's the key takeaways from this, right? So let's talk about bonds. Well, what are bonds? When you buy a bond from a company, essentially what you're doing is you're lending money to the company, right, in exchange for interest payments over time. So it's exactly like how when you borrow, for a mortgage, you're borrowing money from the bank, right? They're giving you a large upfront sum, and in turn, you're paying a mortgage or coupon payments back to them. So a bond works the opposite way, whereas in this case, you're the lender, right? You're lending the company money, and they are making payments to you over time, right? So that is essentially all a bond is. The benefits of bonds in a portfolio, they're less volatile than stocks. We'll be seeing that on the next slide, where they jump up and down less than stocks do. They add diversification to stocks, because let's say the stock market crashes, right? You can still have your coupon payment, your fixed payment kind of coming in. Although, again, there can be risk if interest rates rise, and we'll talk a little bit about that. But it provides a steady yearly return. So, it adds diversification. Again, in case the stock market doesn't do well, you do have some sort of return coming in. The disadvantages of bonds in a portfolio is that the expected return are going to be significantly lower than stocks, right? And they're also not really tax efficient, right? You're going to pay taxes every year on the gain. So as they're making those coupon payments, those interest payments back to you, you're paying taxes. And those are subject to much higher ordinary income taxes, right? So if you're in a large tax bracket, you can be paying as much as 50%, right, on those gains. And that's really bad, especially if yields are low like they are in today's current environment. Contrast this to if you were to, again, that capital gains Apple tax rate, whereas the top tax rate, federal tax rate is at 20%. Then again, if you add in state income tax, it gets higher. But the point being is that ordinary income taxes are significantly higher than capital gains, right? So again, you're getting a lower yield and you're paying more taxes on it. So that's the downside. And again, we talked about, you will lose money if interest rates or credit spreads increase in the future. So everyone thinks bonds are extremely safe. Well, if they can be if you hold it to maturity, but if you need to exit it, you're going to take a loss if interest rates or credit spreads increase, and people don't give that enough weight, and that's super important in this low yield environment. So now let's kind of look at about how bonds have done, right, over the last 11 years. So again, here's the return. You can see it's a lot smaller to begin with. 2009, about 3%. It went up to about 6%, 8%. But these numbers is all within a smaller range. Remember, before we were looking at from, -8 to the 30%. Now it's, between -4 and 10%. So the point being is it jumps up out up and down a lot less than stocks do. And we can kind of see this here in the mean return. The mean return is low, like it's not 14% that stocks are, it's 3.63, but the standard deviation, how much it jumps up and down, is also lower, right? So it's a different risk reward profile, but again, adds diversification to your portfolio. So we can see, again, just the takeaways that the returns are lower than the stocks in the long term, but the standard deviation is also lower. So if you're at the stage of your life where you're risk averse and you just want a steady income, it can be good in higher yield environments, but you need to match bonds with stocks in order to get the diversification relative to your risk profile and how close you are to retirement. So now we're going to look at both stocks and bonds together, so you can kind of get a view of both. Again, you can see that the return here is on the left-hand side goes from -10 to 35. In red, we have stocks, or what's the S&P total returns. In blue, we have essentially a bond benchmark, which is called the aggregate bond index. This is the annualized return. So again, we see exactly what we saw on the previous slides, is that stocks, again, do really, really well, but jump up and down a lot, right? Whereas bonds, don't jump up and down as much, but have a lower return, right? It's lower here. You're not going to get, 32%, kind of from investing in bonds, especially in this low yield environment. So we can see, again, let's just compare mean returns of the bonds to the equity over this period, 2009 to 2019. You can see it's about 3.63% for bonds, whereas almost 14.7%, right, for equity returns over that period. But again, the standard deviation for how much it jumps up and down is a lot lower for bonds than it is for stocks. So you need to utilize this when determining what should I be investing in, right? You have to be okay with the swings to build long-term wealth with the equity markets. So now let's talk about cash, right? Cash is essentially not stocks and bonds. It's just money that is easily liquid and protected. Money market, account, checking account, savings account, all those stuff in your bank. That's considered cash. So the benefits of cash is easily liquid. If it's in a bank and FDIC, with getting FDIC support, you get a government guarantee up to $250,000, right? So there's a guarantee, as opposed to if you're investing in stocks, there is no guarantee that you won't lose money, or bonds, for that matter. The disadvantage of cash is they're extremely low returns, and you should already know this, right? If you have a lot of money sitting in your bank account, is that it's not making much, right? And if it is making anything, if it is an online savings account making 0.5%, all those are taxed at high ordinary income rates, just like bonds are. So there's not much value other than cash is protecting your money. You don't have to worry about short-term losses, right? Whereas if you're investing in stock markets and the stock markets crash, you're going to take a loss. If you're investing in bonds in this low yield environment and interest rates increase or credit spreads increase, you're going to take a loss. So if you're at the stage of your life where you're really concerned about loss, again, cash can help protect against that, and it's easily liquid. You can easily get out of it and contribute to it. The next thing I want to talk about is alternative investments. Alternative investments are an area that I focus on, and essentially all they are is non-stock or non-bond investments. So non-traditional investments, we're talking hedge funds, private equity, real estate, life settlements, which is an area I focus on. So again, non-stock, non-bonds. So the benefits of alternatives is you can have higher returns. The other thing is that you can provide better portfolio diversification if those returns are uncorrelated to the market. And why this is super important in today's environment is traditionally bonds have held the place of providing diversification against equity risk, right, against the stock market crashing. But guess what? When bonds are low and highly taxable, they're really not adding a whole lot of diversification. On top of that, bonds can lose money. So in this type of environment, especially if you're higher net worth, you really want to be looking at alternative investments that can provide better returns and better portfolio for diversification. Let's talk about the disadvantages of alternatives, right? One is that you need to be an accredited investor in order just to invest in a lot of these alternatives. And that often means high investment minimums, right? So whereas you can invest in a mutual fund maybe at a minimum of $3,000 or ETFs with no minimum, often to just invest in these kind of non-traditional investments, you need $250,000, $500,000 at minimum for some of these investments. They can be illiquid, so there can be a long investment horizon. So if you want to invest today and get out tomorrow, you can't necessarily do that with alternative investments. You really have to be looking at a longer term period, so maybe 5 to 10 years at least. And if you're not careful, you just have to check out the qualifications. Some of these are taxed at high ordinary income rates. So yes, the returns can be high, but also the tax rates can be high. So you want to look at that and see how that plays into your financial planning strategy. They can be riskier than traditional investments. They can also, some of them can also be safer. It really depends on the asset class and the investment manager. And here's the problem with using alternatives, in that you have to do a lot of extra due diligence on both the asset class that's being invested and the investment managers. Whereas it's a lot easier to just invest in an index fund. You know that's diversified. You know it's a publicly traded company. So these are the disadvantages again. But in this environment, especially if you're higher net worth, alternatives can provide a better diversification than kind of bonds. So it's important if you're, to take a look at this if this is the category that you fall into. Okay, so now let's kind of talk about, asset allocation. What is the optimal asset allocation for me, and my risk profile given my age, right? So, how do we determine that? How do we determine the optimal asset allocation, right? And as we talked about, it depends on your current age, your desired retirement age, your current net worth, and your risk tolerance. So let's go over some of these factors in a little bit more detail. So here's the factor. We'll talk about your current age and your retirement age, right? So the younger you are, you tend to need to be more aggressive with your portfolio because you want to accumulate wealth, right? And you have a longer time horizon until you retire and need the money. You need to make withdrawals. So typically that tends to mean more stocks in your investment in order to grow the portfolio. However, the older you get and are closer to retirement, you need to be more conservative to protect the portfolio because you don't have as much time to accumulate wealth, and you'll be making withdrawals soon. So you need to protect yourself against what's called sequence of return risk. If equity markets do poor and you're taking withdrawals, it can really hurt your portfolio. So it tends to be as you get closer to retirement, it makes more sense to invest in bonds, right? And that's the overarching theme. Obviously, as we'll talk about, it depends on, how much have you saved, right? And what's your risk tolerance? So that's why current net worth is also important to take it into account. If you haven't saved a whole lot and you are close to retirement, you still need to be more aggressive with it, right? Because you just don't have enough in your portfolio, and you need to build that for retirement. If you have done a great job saving, right, then you can afford to be more conservative because you don't have to worry about running out of money in retirement. So that typically means more bonds. You could be more conservative. The last thing is, of course, your risk tolerance. So people are different, right? Some people are more emotional than rational. So even if it makes more sense to be more aggressive, right, with their portfolio, they're so scared of the short-term losses that they're losing out on long-term gains. And that's why financial advising, it's a risk-return profile, right? If you want to grow wealth, you have to be okay with taking risk. If you're not, even though it might make financial sense, right? It might make financial sense for you. Emotionally, it's not worth it, right? What's the point of, investing a lot in the stock market if every night you're losing sleep, worried about, losing money, right? So again, you have to balance your emotional health with your financial health when it comes to this. And again, people are different. So even though it makes more rational sense to choose one strategy over the other, your emotions might be at a different place. And balancing that out, being self-aware of that is important, as well as, a financial advisor can kind of hold your hand through that process if you are more emotional and are worried about making more emotional decisions versus rational. So again, let's talk about how to determine optimal asset allocation. If you want just a tool to understand your kind of risk profile and what you should be investing in relative to your age and risk profile, this is a decent tool. It's again more of a one-size-fits-all. So, but it gives you some backgrounds if you want to know what percentage of stocks and bonds you should be in. So here we can see again, how asset allocation changes over time. We've just done 30 to 90. Just again, this is an illustrative example. By no means is this implied. This is what you should be in. This is just the point being is that when you're younger, you're investing in a larger equity percentage, right? So here we just own 75 in equity and 25 in bonds. Bonds are red, right? And we can see that over time, this equity percentage decreases and the bond percentage increases as you're getting closer to retirement, right? So this is essentially what you should be, on a high level, what you should be doing. Again, the actual allocation percentage will vary dependent on, again, how much have you saved, right? How much closer are you to retirement, and what's your risk profile? Are you super scared of losing money, versus not? So, but this is a general trend, and again, a one-size-fits-all tool. This Vanguard tool is not bad if you want to get a high-level idea of where you should be. What I do want to talk about is the importance of understanding opportunity cost and how you could actually be hurting yourself by being too conservative, by being too worried about short-term losses. So what I'm going to do here is just use an illustrative example to try to drive home the point of opportunity cost. So now let's say you've invested $100,000 in a diversified stock-only portfolio. After 1 year, it drops by 38% to $62,000, right? So you lost $38,000 here. Well, how do you invest the money going forward? So I'm going to give you 3 options, and I'm going to ask you to kind of just think about it in your head before we kind of go over the risk return here. Okay, so the first option is you do nothing, right? You just keep all of that $62,000 in the diversified stock portfolio. So you have a 100% stock portfolio, right? You had 100% before, you have 100% now. The option 2 is to sell half of that. So we're going to sell half of the $62,000. We're going to sell $31,000 of the stock portfolio and buy a bond portfolio with that $31,000. So now we have a 50% stock portfolio and a 50% bond portfolio. Number 3 is that we're going to sell the entire stock portfolio of $62,000 and buy $62,000 worth of bonds. So now we're in a 100% bond portfolio. So I want you to just think about it for a second. What would you do given your risk profile and maybe your financial knowledge, and which of these options would you choose? I'm going to give you a second, and then we're going to kind of go over the risks and benefits of each. So now hopefully you've kind of thought about this for a second. And the reason why this is important is because in 2008, the stock market lost 38%, right? So if you actually had $100,000 at the beginning of 2008, by the end you would have lost and that'd be at $62,000. So this is kind of a good test to be like, okay, I made a decision, right, of what to do. Where would I be today if I made that decision and I kept that decision and didn't change it? So in this slide, what we'll essentially be showing is that the repercussions of that financial decision or emotional decision, right, depending on your background. So how did that help me or how did that hurt me, my decision, right? So again, let's go over our options. Keep it all in the stock portfolio, half in the stock, half in the bonds, or sell the entire stock portfolio and buy the bond portfolio. So if you chose option 1, right, and you kept it all in the stock portfolio, at the end of 2019, we can do some math and figure out what it would be. So that $62,000 would have grown to $279,000, right? If you kept half in the stock and half in bonds, here's where you'd be. You'd be at 185, right? So if you sold the entire stock portfolio and bought a bond portfolio, you would only have $91,000. So that 100% bond portfolio is only at $91,000 11 years later, right? Or 10 years later, right? The importance of showing this is that to show the effect of opportunity cost, right? And of being scared, of being emotional and pulling your money out of the stock simply because you had a loss, right? So that decision cost you, almost $200,000, right? As opposed to keeping it in a stock portfolio. Now, this is not to say that this is 100% the right decision, right? Keeping it 100% in the stock portfolio doesn't necessarily mean because you came up with more money that this was better for you. If you spent the last, 10 years, not being able to sleep because you were worried about more losses, right? Again, you have to choose an option that matches your risk return and risk profile, right? But you have to be aware of the repercussions of your choices here. So we can be aware that, look, I'm losing a lot of money because I'm scared, and you can still make this decision. It doesn't make this a bad decision. It's just it's the best decision for you, but not for everybody. And that's why the decision with regards to investing really depends on who you are as a person, your goals, and it's more holistic than kind of just doing the math. It's really understanding where you are, and if you can understand the risks and benefits and then make the decision, that's the whole point of financial advising is here's the pros, here's the cons, you make the decision depending on who you are. But my job or the financial advisor's job is to present you with all the risk and cons so you can make an educated decision, right? So now let's talk about asset allocation, doing it by yourself. So we're going to be talking about low-cost index funds on this slide. So again, once you determine, your asset allocation, what percent of stocks you should be in, what percent of bonds you should be in, here's ways you can actually invest in those funds in a low-cost way. So let's look at 3 different opportunities. Fidelity, Schwab, and Vanguard all have S&P 500 low-cost index funds. So you can Google this, you can do some more research. But the point being is that The expenses are very, very low on these funds. So again, you can see it's 0% actually for Fidelity. So they're charging you no fee. There's no commissions involved. They either have no minimums or it's a cost of one share. And you can see it's really, really cheap to invest in low-cost index funds, get a diversified stock portfolio by yourself with very little work, right? Again, so after you've determined your asset allocation, the amount that should be in stocks, you can quickly and easily go and invest in these. And you can see the fees are very, very low. So here they're actually not charging you a fee, and you might be wondering, well, how are they making any money? Well, the idea is if a Fidelity gets you in, right, and they're losing money here, that they'll hopefully be able to upsell you later, right? Similar concepts with the other ones. But you can see, again, look how low the fees are. So, at 0.02%, what does that mean, right? So that means if I invest $1,000, right, I'm paying just 20 cents a year, 20 cents on $1,000, right? So the expenses are super, super low. And all of these guys are just resulting or relying on volume. Like they'll get people in and they'll do enough in volume that it makes sense, or be able to upsell you later. But here's essentially, again, three great options for you if you're interested in doing kind of low-cost stock index investing by yourself. I put a little star here because I think Schwab might require a small fee, if you're exiting or selling. But the other ones, again, it's largely commission-free, and the expenses are low. So again, if you want to do it yourself, again, determine your asset allocation, and here are three great stock index funds for you to invest in. So now let's look up at the bond side of the portfolio. Where do I go to invest in? Bond index funds, again, low cost bond index funds, again, back Fidelity, Schwab, Vanguard. You can look up all these ticker symbols here. It invests in the aggregate bond index, which we were referring earlier. That's kind of the benchmark here. Again, we can see the expenses are a little bit higher to manage bonds. Again, same thing, no commissions, minimum one share, or no minimum, or at the very maximum, you have to buy one share. So again, if you want to do that portion yourself, the asset allocation, here's the bond portion of your portfolio. Let's say you want 40% bonds. You can easily invest in 40% of your money into one of these bond portfolios by yourself. So obviously, right, like if I can do this by myself, why do I need a financial planner, right? If asset allocation and getting the index funds cost me 0.05% or less, why do I need a financial advisor that charges me 1% to 2%, right? And the answer is because a good financial advisor is doing a lot more than just putting your money in index funds. They should be implementing a tax-efficient financial plan and strategy, and using various tools to minimize your taxes and help you accumulate wealth in the long term. So they're providing a value add. That being said, not all financial advisors are providing a value add. A lot of them are just kind of marketing to you for people who don't know any better about finance and not doing much other than just putting you in a high expense index fund, right? Which justifies their fees, right? So, or rather doesn't justify their fees. So, part of this is being understandable. Who's a good financial advisor? Who's implementing strong tax efficient strategies? But here are the ways in which good financial advisors can add value, in which you really should be paying attention to as you interview them. First is helping to choose an optimal asset allocation, right? What is the best asset allocation strategy for my risk profile? So earlier we talked about how you can kind of do this yourself, but it's again, kind of a one-size-fits-all. Is not as granular, whereas a financial planner can really drill down. They can really look into what you're invested in, really understand your risk profile, and this requires a lot of kind of questionnaires and kind of due diligence, but they can really make a specific recommendation for you, not kind of a generic one. The most important thing, though, is financial planning. Implementing tax-efficient financial planning strategies, helping you with your taxable accounts versus your retirement accounts, what you should be investing and contributing to. Coming up with strategies to reduce your taxes. Well, how are we going to reduce taxes in the long run? So these are all things that a strong financial planner should be able to help you out with. Again, not everyone's a strong financial planner. Some people are just trying to, get your money, invest in kind of low-cost funds, and then collect a fee. But a strong one will be doing this. The other thing is estate planning, right? Once you're comfortable with your retirement, the next goal is how do I pass my assets on to my children tax-free? So that is, again, a huge value add because, again, if your accounts, as we'll talk about later, are in IRA accounts and you pass away, your children will be paying taxes on that. And there are more efficient ways of accumulating wealth than in a vehicle in which your children will pay taxes on. The last one is emotional handholding. Now, again, this is where a financial advisor is essentially working as your therapist, to prevent the client from, panicking and selling low, or from buying high. They're your financial therapist. So depending on where you are, like if you can do the check your emotions and check your biases by yourself, that's awesome. So that's one less thing a financial advisor has to do for you. Unfortunately, a lot of people pay this high fee of 1% to 2%, right? Not because the financial planner is implementing the previous three, but simply because they're developing trust, and they know that the client is more emotional. And if they just establish trust, they can collect this added, extra fee just essentially for being your therapist. So that is a value that they can provide, but I'd recommend that if you're aware of your bias and aware of your emotions, you can kind of keep this in place. But the important thing is that they do provide this value. You just have to be aware of it. Like, what are you actually paying for when you get a financial advisor? Ideally, they're doing this as an add-on. Hopefully the only thing they're doing is not just emotional handholding. They're doing these three as well, right? So, okay, so let's talk about, what are some topics I should be talking about with my financial advisor, right? The first is, if you're worried about not having enough money for retirement and worried about your asset allocation, they can come up with a financial plan. They can help implement, plans that'll help, again, reduce taxes and help you accumulate wealth and what to contribute, etc. If you're worried about market or interest rate risk, we talked about, the yields are low right now, but if interest rates rise or credit rate rise, you lose principal on your bond funds. If the stock market crashes, you'll also take losses. So hopefully they're comprehensive and can talk to you about guaranteed lifetime income, no commission indexed annuities, indexed universal life as it applies, right? These are ways of kind of protecting your principal, especially in a low yield environment, right? So these are some of the strategies we work on, kind of more technical with the financial advising community. How do I maximize after-tax returns? So we'll talk about the benefits of asset location, right? Putting your stocks and bonds into a structure that minimizes the taxes on them. Roth IRAs, conversions, 401ks, traditional IRAs, SEP IRAs, solo 401ks should also be in here. No commission indexed annuities, indexed universal life. Passing on wealth to the next generation, right? We talked about there's certain ways of passing on money tax-free to the next generation, and they should be helping to talk to you about that and the value of spending down your retirement accounts first. But ultimately, it's how do I use financial planning tools to increase my wealth or have a better retirement or pass on money tax-free to my children, right? So these are all important topics as you accumulate wealth to discuss with a financial advisor, and use these talking points to determine who's a good financial advisor and who's not, Again, let's go into it a little bit more. Well, is a financial advisor worth it, right? And it kind of depends, right? On the first one is, on the fees relative to the assets involved, right? So if they're charging 1% on an 8% stock portfolio and they're doing a bunch of financial planning strategies, they're showing you and implementing strategies to minimize taxes on that portfolio, absolutely, 100% it could be worth it, right? Because in the absence of that, you'd just be paying more in taxes, right? So whatever you're paying for the fee, they're essentially providing added value in terms of minimizing taxes, right? So 1% on an 8% stock portfolio may very well be worth it, right? Depending on everything that they're doing for you. However, if they're charging 1% on a 2% bond portfolio, again, you're losing almost 50% of the gains, and that's before taxes, right? After taxes, what are you really walking away with? And, one of the issues right now is that for advisors is that on an after-tax basis on bonds, the advisor is actually making more than the client, right? So what's the point, So again, financial advising, as you talk to your advisor, is how do you validate or value them, right? Given this, and the fees depend relative to the assets, right? So it might be better for them to manage your stock portfolio, right? But you keep your bond portfolio in a low-cost index fund by yourself, so you're not paying that 1% fee. So these are things to talk to your financial advisor on, and a savvy one should be able to address this. Like, how, why should I give you my bond portfolio if you're essentially getting 50% of the fees and I have to pay taxes? Why? So. The next thing is, to think about is it depends on the depth of their expertise and ability to provide better after-tax, after-advisory fee solutions, right? So it can't just be they're sticking you into low-cost index funds, right? Because otherwise you can just do that yourself, right? What value are they providing? Why should you pay 20 to 40 times more unless they do more than asset allocation? What is the value of their expertise that they are providing for that extra fee? And you really need to drill down and talk about these. What are the tax efficient strategies you're using? Why should I be doing this? Why should I be paying you so much more when I could do this part myself, right? And they should be able to articulate that their value proposition, right? And it should be more than just hand-holding. Again, the last one is depends on the ability to understand your specific needs and craft client-specific solutions for you. Again, not one size fits all. You can do the asset allocation generic and understand a high level, but again, if you want to drill down more and get a more specific solution, that's where a financial advisor can kind of help you. And look at your different goals, right? What is your risk tolerance? How worried are you about losing money? And can I get you more comfortable with taking on risks if in the long run it's better for you? Do you want to spend your money or do you want to pass on the wealth, right? Because there's different strategies depending on if you want to spend everything in retirement or if you want to pass it on. Would you consider moving to another state simply to reduce taxes, right? So there's a lot of different things, and I could go on and on about the values and strategies that financial advisors can implement. But again, these are things that they should be talking to you about. There's different strategies dependent on who I am as a person, not, a one-size-fits-all approach. Okay, so now let's go ahead and talk about tax-efficient investing. So why is it more important to focus on after-tax returns than kind of pre-tax yield and the value that financial advisors provide in terms of creating better tax-efficient strategies? So let's just look at a quick example, right? Let's say you can invest in portfolio A making 10% or portfolio B making 7%. Which one do you choose? So at the top of the head, it seems easy, right? Like, I'm going to choose the 10%, right? That's higher than 7%. So now let's kind of make it a little bit more difficult, right? What if investing in portfolio A meant that the gains would be taxed at 50%, but investing in portfolio B meant that the gains would only be taxed at 20%? Well, now it's a different proposition, right? It's not as simple. You have to do some math here to figure out, well, what's actually better? And so let's just do some quick math and look at that, right? So we talked about portfolio A. The gross return is 7%. The tax rate on the gains is 50%, right? So if you look at, well, how much of this 10% am I losing to taxes? It's 50%, right? So I'm losing 5%. So my net after-tax return to the client is only 5%, right? 5% is lost just to the taxes, right? Whereas portfolio B, yes, it's earning a lower amount, but the taxes are also lower, right? So instead of losing 5% to taxes, I'm only losing 1.4%. So on an after-tax basis, I'm actually coming out ahead at 5.6%, right? And this is why it's really important to focus not on pre-tax yield, but on after-tax return. How can we provide structures, right, that reduce the taxes on our investments such that we have a greater after-tax return, right? And you can do that by just using the tax code. You're using the tax law to your benefit, so you're not taking more risk. So again, don't focus on pre-tax yield, focus on after-tax return. So now let's talk about, taxable versus retirement accounts, right? So what are the differences in terms of how these are treated tax-wise for your purposes of investing? So again, let's look at example of taxable accounts. Again, you have a Vanguard, Schwab, Fidelity brokerage account, right? That's just simply taxable. Versus retirement accounts, which can also use these, but Vanguard, Schwab, Fidelity, etc. But the names you might hear of are 401k, traditional IRA, Roth IRA, solo 401k, etc., etc. So these are all retirement accounts and get preferential treatment from the tax code in some capacities. And we'll be talking about that a little bit later. The investment categories within them are the same, right? So you can invest in stocks, bonds, and alternatives within your taxable accounts. You can invest in stocks, bonds, and alternatives within your retirement accounts, right? One of the key differences, though, is the long-term tax treatment, right? So stocks, most of the gains are coming from capital gains or capital appreciation. So those are taxed at long-term capital gains, which, as we mentioned, are a lot lower than ordinary income for most people. Bonds, on the other hand, those gains, are, the coupon payments are taxed at ordinary income. There is some capital appreciation here, but by and large, the bulk of your income here is going to be on ordinary income coupon payments, right? Whereas in retirement account, all the gains are taxed at ordinary income, right? So, as you can quickly see, one of the problems of putting stocks into retirement accounts is that you're giving up this long-term gains and now paying ordinary income payments on it. So while you do get tax deferral in these accounts, or tax-free income rather, growth for the Roth IRA, it does come at this, exchange is that, look, if you put stocks in a traditional IRA, you're going to pay higher taxes at ordinary income. The idea being, well, if you're going to do that, you're hoping that in retirement your tax rate drops. So, not to get too complicated and overwhelming here, but the point being is that look, there are trade-offs to doing both, and you need to understand them. The last thing is, can you pass on your to your beneficiaries tax-free? And if it's in a taxable account, you can pass on that wealth tax-free. Whereas, except for the Roth IRA, if you try to pass on that wealth, right, your children will pay taxes on it. And just to use a quick example. Again, let's say we have our Apple stock. I bought it for $1,000. I keep it for 30 years. That grows to $100,000, and I pass away, and I give that to my kids. My kids will get that $100,000, and they won't pay taxes on it, right? So they'll just get what's called a step up in basis. But if I have that $100,000 in a traditional IRA, right, my kids will pay taxes on it because I have not paid taxes into putting it into that traditional IRA. So now my kids will have to pay taxes on it. So a couple key takeaways here are that long-term capital gains tax rates are lower than ordinary income tax rates for most people, right? Your beneficiaries will have to pay taxes on anything left in your tax-deferred retirement account. So anything except for your Roth IRA, you'll have to pay taxes on. So let's talk about asset location, which is just about matching stock and bond portfolios with the structure that minimizes taxes, right? You want to minimize taxes. So by and large, what asset allocation means is that in your taxable accounts, you want to hold stocks, right, because of preferential treatment. Retirement accounts, we're talking mainly your traditional IRAs, your 401ks, et cetera. You want to hold mainly bonds. Again, these are long-term strategies. The reason being is that long-term stock gains in taxable accounts get beneficial tax-deferred treatment and lower capital gains treatment. So again, the top federal bracket for capital gains here is 23.8% on your stocks. However, if you put your stocks in your retirement accounts, we talked about the stock gains are no longer taxed at capital gains. They're taxed at ordinary income. So essentially, you're giving up the 23.8% for the top income rate. If you're in that top bracket of about 40.8% in that top bracket with the surcharge fee on top of it. So again, if you're just putting stocks into your retirement accounts, you're really hoping that in retirement, that your ordinary income will drop, right? Bond funds distribute most gains as short-term ordinary income, anyways. And they're not deferred in taxable accounts. So if you put your bonds in a taxable account, then like every year you're paying taxes on it. Versus if you put it in a retirement account, you can defer those taxes, right? So those gains that you're getting every year are not being taxed until you withdraw, 30 years from now. So you're getting beneficial treatment by putting bonds into a retirement account. And this is the high level idea of asset allocation. It's like, look, for your long-term plans, your stocks, you want to put it in taxable accounts, especially since, again, that capital appreciation when you die will pass on tax-free to your beneficiaries, and then nobody will pay taxes on it. Versus on bonds, right, you're getting taxed every year, so it's better to put that in a retirement account where you can at least benefit from the deferral. So again, asset location means really focusing on putting stocks and bonds in the structure that minimizes taxes, and for most cases, that's putting stocks into taxable accounts for your long-term strategies, and then your long-term bond strategies should be in retirement accounts. So we're going to talk about the benefits of tax deferral, right? Why it's beneficial to defer taxes or defer gains on those taxes, especially bond gains, until you're in lower tax bracket like retirement. So let's talk about why the deferral of bond gains are valuable, right? So let's say you're a high earning income professional, right? You're a doctor, a lawyer, dentist. You're already at the highest tax bracket, so you're paying the highest tax rate. If you're here in California, that's close to 50%. So you're working, every year, you're on your W-2, the marginal tax rate is 50%. So if you're investing in bonds in a taxable account, you're paying that 50% on the bonds, right? Whereas, if you've done proper financial planning, right, at the moment you retire, right, you won't be having income coming in, right? So your tax rate is going to drop until you start making withdrawals, right? So again, this is your retirement before required minimum distributions and Social Security. You've stopped working, your tax rate, you're not taking any income, right? So if you defer the bond gains when you would be paying 50%, and then slowly take it out after you retire, when you're in lower tax brackets, you're just benefiting from the savings and taxes, right? Would you rather pay 0% or 10% or 20% on your tax bond gains, or would you rather pay 50%? So, by deferring, taxes on bond gains, you can defer it until you're in this period here, and then slowly take it out over time at lower tax rates. So this is why it's beneficial to defer taxes on bond gains, right? Again, you're going to defer bond gains during the high tax rate ordinary income working period here. During this, until you get into this low tax rate financial planning window, which is before you start taking required minimum distributions of Social Security. So there's a financial planning window here you can utilize to benefit yourself, to pay less in taxes over the long term, which means more after-tax wealth for you. Again, another strategy is if you're looking at a secondary home, if you're in a cold state, you're looking to go to a warmer state for 6 months, you can essentially defer all these taxes, right, until you get in retirement, go to Florida, or some state for 6 months, and then take out all your gains because there's no state income tax there, and benefit from that. So there's the point being is not that you should do this strategy, but that there's multiple opportunities that you can benefit on just from strong financial planning and from tax deferral. And that's, again, what your financial advisor should be helping you work on. One thing I did want to leave is that, get you to understand is, well, there is an opportunity to pay 0% on capital gains up to $80,000 a year if you're married, right? And how do we do that, right? Well, again, we talked about this window in optimal tax planning. Well, if you defer taxes and you're in retirement, you have no income coming in, right? The first $80,000 of capital gains will be tax-free. Again, this assumes you take no other income. You can essentially, start taking away money from your taxable accounts, and up to $80,000, you're going to pay 0%. Obviously, if you have, a $50K pension, you can't take out the full 80. You're going to take out, $30K will be paid at 0%. And again, this is if you're married, right? But the point being is that there's an opportunity here to benefit from the tax code and tax deferral, right? So if you do your proper financial planning and, you put your stocks in your taxable account and your bonds in your retirement account, you can kind of play with this to your benefit to pay less taxes. Again, the 2020 married tax bracket for 0% capital gains rate is up to $80K in income. So if you have no income coming in, you can take up to $80K in capital gains and pay 0% on it. If you do have some income on it, it's obviously $80K minus the income that's coming in. Again, it's a play. Talk to your financial advisor about it. But the high level point I'm trying to articulate here is that you have an opportunity to benefit from lower tax rates in retirement with strong financial planning. Now, if you don't do strong financial planning, you're going to end up paying high tax rates in retirement, or giving up long-term capital gains for higher ordinary income rates. And this is really why financial advising can be so important, because there are strategies to implement to reduce taxes that'll benefit you, and a financial planner should be talking to you about them. So now we've kind of talked about what you can do yourself versus what you should look for in a financial planner. Well, what should I look for? Who is a good financial advisor for me? What are the benefits and cons? I'm going to be talking about fee-only versus fee-based advisors, and what are the differences between the two? What are the pros of one versus the pros of the other, and the cons as well? And you can make an educated decision as to what to look for and who to go with. So again, we're going to be talking about two types of advisors. One is fee-only and one is fee-based, and we'll talk about the differences here. So let's start with the fee structure, which is the naming convention for these. A fee-only advisor charges a fee in a variety of ways. So it's a percent of assets under management, right? So if let's say they're managing $1 million for you and they're charging 1%, that's roughly $10,000 a year. They could also not base their fee on assets under management, just charge you an hourly fee, maybe, or just a flat fee for the service, the financial plan. A fee-based, will typically also take percent assets under management as well as commissions on products they sell. And it's kind of a play here. They'll keep their percent AUM fee low, but they'll make their money on the commission side. So you have to compare everything together, not just, compare the AUM fee here versus the AUM fee here, and assume that this is, one is cheaper than the other, because they're making their money on the commission side. Again, fee only. Here's actual examples, numerical examples. Percent asset under management. Let's say it's 1.75% up to $1 million, and then 1% for assets above $1 million. So it's a graduated type structure. for some of them. Again, just ask. You can get an idea. The next hourly fee, let's say they're charging you $250 for every hour, of consulting or work that they do. The other thing is just a flat fee for service. So a $4,000, let's say, for a financial plan. Versus what a fee-based guy might do is they might not charge you 1.75%. They might charge you only 1.25% up to $1 million and then 1% above. So you're like, oh, this is cheaper, right? But they're making money on the commissions they sell to you. So that could be 7% to 100% of all your first year products. So even though their AUM fee is lower, their commission fee could be higher. And we'll talk about later is that the conflict of interest, right? Well, if they're selling you bad products, right, then you're not only are they making more commissions, but you're getting a worse return for buying a worse product. The advantage of a fee-only financial planners, typically they're fiduciaries. They're trying to act in your best interest. There's no conflict of interest in terms of their or no explicit conflict of interest in the terms of trying to just sell you something that is that will make them money in terms of commissions. They tend to be, however, we'll talk about in a little bit, is that how, while it might appear to be no direct conflict of interest, they do have competing ideas that they're working for. We'll talk about that in a second. They tend to be more math tax savvy. So the fee-only guys, you're going to see CFPs, JDs, a lot of experienced professionals that they'll either have in-house or access to, typically in-house. And they have a deeper understanding of tax laws, Roth IRAs, asset location. Whereas the fee-based guys, the advantage to them is they have a full array of financial planning tools. So they're using guaranteed lifetime income, annuities, long-term care, which these guys won't do simply because, again, most of these products are commission-based. So even when we talk about the disadvantage of fee-only guys, there's a couple. One is that they don't use a full array of financial planning tools. So they're not fully comprehensive. So if guaranteed lifetime income is better for the client in terms of you don't have to worry about the downside, can provide better value, these guys won't actually implement it because they don't get compensated on it, even though it's better for the client, right? So the other thing is if they're charging you a percent AUM fee, right, they may be more concerned, right, with keeping you not losing money, right, than kind of growing your own wealth because they want the percent AUM fee, right? Or they may be super aggressive with your money because they want to grow their AUM quickly, right? So, while we said there's no conflict of interest, there are competing, disadvantages. And so that's one of the disadvantages is one, that they don't use the full array of financial planning tools. So they might not use guaranteed lifetime, annuities, life insurance, any of these things, because again, they just won't get compensated on it if it's a commission-based product. And that hurts you, right? Whereas, on the opposite side, the fee-based guys, there is a conflict of interest because most cases, the products that they're selling you aren't necessarily in your best interest as much as in their interest of making them a high commission. So how do you balance this, right? If you're a fee only with using financial planning tools that are in the best interest of the client versus the ones that are not, right? Because ideally what you would have is a fee only advisor who's educating you about which of these tools are good for you and which is not. But again, it's hard for them to do that if they're not getting compensated for doing it. Whereas the products that the fee-based guys are going to sell you are the ones that are not going to be in your interest, but are in theirs, right, to make them a high commission. So this is the disadvantage. Again, the fee-only guys not using fully comprehensive tools, whereas the fee-based guys, there's a conflict of interest, and they're going to, they have an incentive to, maximize their side, their commissions versus, your benefit. Again, the other downside with fee-based guys, I think they're limited in products by broker-dealers. So even though that, again, there's a wide array of financial planning tools, they might be stuck in only using one carrier. So let's say, company X offers, an annuity. They're not going to show you company Y's, company Z, company W's annuity. They're only going to show you company X, right? So even though, a financial planning tool like guaranteed lifetime income might be in your best interest, if they can only show you company X and company Z's is better, right? They're limited in what they can do. So, one thing I do want to take away is that most commission products are not necessarily in your best interest. So just be aware of that, right? These tools actually can be great tools. Don't get me wrong, but how most of the ones being sold are high commission products that are not really in your best interest. So if you are considering these tools, look for the no commission ones if they're possible, or low expense, and be explicit on asking about what the commissions are for this product and how this compares to other commissionable products. So these are the key things to look at. The fee-only, high level, tend to be more, fiduciary, more math savvy, and more acting in your best interest. The fee-based guys, while they have a wide array of financial tools that might be a better fit for you, but again, they're going to get larger compensation for it. So you're balancing this need between fee-based guys having more tools at their disposal versus fee-only guys trying to act in your best interest but not always having the tools. So just keep that in mind. So here are questions to ask, in terms of you're looking at a financial advisor. Are you exclusively a fee-only advisor, or do you also get paid on commission? Try to understand the conflicts of interest and ask them with, are you more concerned? Another question is, are you more concerned with getting your percent AUM fee or, providing advice that's in my best interest, right? If you're a fee-only guy, do you utilize guaranteed lifetime income or no commission annuity solutions? That might be a better fit. We talked about in the previous slide. Some of these solutions are a better fit, and mathematically, as a math guy, they actually are better. But again, if they don't understand how to use it, they're not familiar with it, they might not be providing you solutions that are in your best interest, right? So again, the next thing that you should be focusing on is what type of financial planning strategies do you utilize to maximize after-tax, after advisory fee returns in a low bond yield environment. Again, this really helps you understand how qualified these advisors are. If they're just simply putting you in a stock and bond portfolio, which you could do on your own, they're not doing much for that 1% fee. Especially on the bond portfolio side, where bond yields, like we talked about, are around 1.2% right now. So if they're putting in a bond fund making 1.2%, they're charging 1%. Like, how is that better for you? How is that a good idea? Why shouldn't you be doing that for yourself, right? Again, strong question to ask. Do you have CFPs or other credentialed expertise professionals on your staff? So again, it helps you just understand the qualifications. Now, that being said, it doesn't mean that somebody with a CFP is 100% time more qualified than somebody without it, but it's a good indicator. Again, you can have other credentialed expertise professionals on your staff who have more knowledge but don't have a CFP. So don't use this as the end-all be-all. For example, I don't have a CFP, but I'm knowledgeable about these topics a lot more than some of financial advisors who do have CFPs who are just salesmen, right? So again, you really need to drill down. This is a good indicator, but not the end-all be-all. But just try to understand what kind of tax professional. Do you have estate attorneys on your staff? Do you have CPAs? This is a good way of trying to understand if they're really comprehensive. And then, if you're mass affluent or a high net worth individual, what specific strategies do you utilize for high net worth individuals to increase after-tax income and pass on wealth to the next generation? Do you utilize things like alternative assets that might provide better diversification than low yielding bonds, right? So again, depending on where you are, these are the types of questions you should be asking, to determine if your financial advisor is qualified. So where can I find a fee-only advisor? Here's some sites where you can look on to find fee-only advisors if that's what you're interested in doing. NAPFA, XY Planning Network. You can kind of look here. You can contact us if you're interested in working with fee-only advisors that we work with and we trust and we recommend. You can drop us an email. But again, for most people, I'd recommend the fee-only advisor simply because while the fee-based can provide better solutions, again, there's a conflict of interest. A lot of those guys are just trying to sell, high commission products, not necessarily in your best interest. So the right fee-only advisor, again, from my perspective, will charge you a flat fee, independent of your AUM, more based on the work that they do. But they will also start implementing some of these, these kind of financial planning tools that might be in your best interest, whereas a fee-only guy who's just doing a percent AUM fee might not be. So things to consider as you're looking into this. Again, I would recommend the fee-only guys because they're, at least they're trying, even if they're not using the full tools at their disposal. At least they're trying to act in your best interest. So how can we help? How can Colva help? We don't work with clients directly, but we can refer you to fee-only advisors that do utilize tax-efficient financial planning strategies, including the ones I mentioned. Again, so the best mix of the two are fee-only advisors that are kind of charging a flat fee, not based on your AUM, but are utilizing kind of comprehensive financial planning solutions like, no load annuities, universal life as it applies, comprehensive tax estate planning. So they're doing the best of both worlds, right? So they're not just dismissing kind of financial planning tools, but they're also kind of utilizing it in their practice along with just traditional tools like retirement plans and, advising on your taxable versus retirement accounts, Roth IRAs, traditional IRAs, et cetera, et cetera. The other ways what we're trying to do is build up a community of knowledge, right? We're really focusing on educating financial advisors who do want to be tax savvy rather. and the financial advising community to create better tax efficient financial plans. So for those financial advisors who don't want to be salesmen, right, who don't just want to extend a handshake and a smile and collect a huge fee for not doing much, but who really truly want to add value, that's what we're trying to facilitate. On top of that, we want to educate clients. Like, look, there's a lot of great financial advisors doing great work, and there's a lot of financial advisors just being salesmen. And we need you as the client to be able to discern between the two. Otherwise, the salesman will keep winning because nobody knows any better, right? So don't buy things from people who are not providing added value. Be able to hold those advisors accountable, right? And the way you hold them accountable is you become educated to a level to know this person is more qualified than the next, and really truly value the ad that comprehensive financial planners can provide, because they can provide a lot of value. It just currently a lot of financial advising isn't about providing value. It's just about selling people things. So we're trying to create a community. That's why we're doing these presentations. We're working with fee-only advisors to kind of create better tax-efficient strategies. If you'd like to follow us, you can do so on our website. You can see how we help financial advisors. Our blog has a lot of really cool, innovative, tax-efficient financial planning strategies and advice, both for everyday clients as well as financial advisors. Eventually, although not now, probably in 2021, we'll set up a Facebook group where we'll just share these strategies, so people can learn at their own discretion. Again, if you'd like to email us and learn, I need financial advising help, who would you recommend? We can provide those as well. If you want to follow us on LinkedIn, here's my LinkedIn account. And that essentially kind of concludes the presentation. I want to thank you for taking your time, and hopefully this was helpful to you.